Former Deputy Treasury Secretary Stuart Eizenstat joins us now from Washington, currently a partner at Covington and Burling. Stu, always good to have you on the program. And before we get to the Fed, I want to get to Obama and his job speech tomorrow. And Mike was just talking about all this fear in the markets right now. Anything you think the president can say tomorrow can help allay some of those fears?
Well, I think he's going to make it clear that the U.S. has to get back on a growth path through two components, Betty. The first will be a short-term jobs stimulus program heavily oriented toward tax reductions that hopefully Republicans in the House can support. This would be both an extension of the 2% payroll tax that employees have enjoyed, which is about $1,000 for the average taxpayer in benefits, but extending that for the first time to employers who would also get a 2% tax reduction. They may also look at a tax credit for hiring. They're going to propose a nationwide program based on the Georgia Works program, which allows an unemployed worker to take his or her unemployment insurance, in effect give it to an employer who will then train them and take them. They'll propose passing the free trade agreements. And I think that there'll be some incentives for investors to buy some of the foreclosed properties that have been an overhang and have kept mortgage prices at rates that are very unsustainable. And so I think something to try to get the housing market back. Then there'll be a long-term component in which the president, I'm afraid, will not fully embrace the Bowles-Simpson deficit reduction program I would like, but he will suggest that his program be fully paid for, Betty, and will challenge the new special committee to go beyond the $1.5 trillion in cuts with specific suggestions shortly after the speech.
And we've got Congressman, actually, Chris Van Hollen to talk about the deficit reduction in a little bit. But Stu, again, I want to get back there. You've outlined for us what we've seen, already reported, which is, all these different details that Obama is going to unveil tomorrow. But again, I get back to that question, though. Is that a bar that is, is that a bar high enough in order to allay the fears in the markets?
I think it's going to have to be combined with Federal Reserve action, and I think this is where Ben Bernanke will come to the rescue. What I would expect the Fed to announce in 2 weeks at their next meeting is a program to lower long-term interest rates by selling their short-term portfolios of Treasury bonds and buying more of the long-term rates. That will reduce borrowing rates for businesses, it will reduce mortgage rates, and it will provide an additional monetary stimulus. So if you combine what the president's going to suggest with what the Fed is going to do, then I think you have a credible package.
Okay, a credible package that you think will allay this fear, right?
I don't think it will fully allay the fear because we have a European crisis that's overlaid on that, and the European economy and ours, particularly on the banking side, are very tightly integrated. And as you were just told, the financial system in Europe is in a very bad shape. In many ways, it's sort of like where we were in 2008. Our banks were holding mortgage-backed securities, which turned sour. Their banks are holding sovereign debt, which is turning sour. And the solution to this is going to have to be a painful decision by Europe to create the kind of institutions we have. That is a Eurobond in which the backing is by all 17 Euro countries so that the markets can't pick out one country over another. This is a major step. They're going to have to move toward a financial union to complement the monetary union. You can't have one without the other.
Almost like what we saw in 2008. Here, are you saying, Stu, something like that they're going to have to then also put together some facilities like TARP or TALF in order to, keep the capital cushions for their banks, those types of measures?
Yes, they already have agreed in July to a European Financial Stability Fund. But here it is, September, and the 17 governments still haven't approved it. It needs to be done immediately. The European Central Bank needs to continue to purchase the sovereign debt from the banks to help them get more capital of countries like Italy and Greece so that their borrowing costs are less. But the really key point is they have to move to a Europe-wide system. They cannot simply put Band-Aids on this anymore. They have to recapitalize their banks. And because we're so integrated, Betty, what the president says in his speech on Thursday has to be complemented by the Fed's actions and by Europe. We're all in this together.
All right. Stu, thank you so much. Really appreciate your time.